Welcome to Module 1, the Fundamentals of Business Finance. If you've ever felt like the finance department speaks a different language, you're not alone. But the truth is, every decision you make, from hiring a new person to choosing a new supplier, has a financial ripple effect. Our goal isn't to turn you into an accountant. It's to give you the language and the framework to effectively manage your budget, justify your projects, and drive profitable growth for the entire company. Let's start with the foundation. Every piece of business finance boils down to three core concepts. Think of them as the three legs of a financial stool. Assets. Simply put, these are things the company owns that have economic value. Assets include cash, money owed to us by customers, that's accounts receivable, equipment, and the inventory we hold. They are resources used to generate revenue. Liabilities. These are what the company owes to others. Liabilities include bank loans, wages owed, and money we owe to our suppliers. That's accounts payable. They represent obligations to outside parties. Equity. This is the owner's stake. It's the net worth of the company, what's left for the shareholders after all liabilities are paid. Assets equal liabilities plus equity. If this equation doesn't balance, something is wrong. This equation is the foundation of the balance sheet, which we will cover in Module 2. Now let's define the three words that describe the flow of money in and out of the business: revenue, expense, and profit. Revenue is the total money brought in from sales of goods or services. It is the top line. Expenses are the costs incurred to generate that revenue: salaries, utilities, marketing, rent. Profit is what's left over. If revenue is greater than expenses, you have a profit. If not, you have a loss. A final key term is margin. This is profit expressed as a percentage of revenue. If your product costs $60 to make and sells for $100, your gross profit is $40 and your gross margin is 40%. Managers across the board focus on increasing margins. This is where things get tricky and often confusing for non-finance teams. It's the difference between accrual and cash accounting. Accrual accounting records sales and expenses when they are incurred or earned, regardless of when the cash actually changes hands. If you invoice a client today, that's revenue today, even if they pay in 60 days. Cash accounting only recognizes transactions when the cash is physically received or paid. Let's say you sell $10,000 worth of services in December, but the customer pays in January. Under accrual, that $10,000 boosts your December profit. But under cash, you still have a cash deficit in December. Why does this matter? Because a company can show a big profit on its P&L, accrual basis, but still run out of cash and go bankrupt. This is why the cash flow statement is so important. Every dollar you spend or bring in lands in one of three buckets: asset, liability, or equity. And the profitability reported on paper, accrual, is not the same as the cold, hard cash in the bank. That foundation prepares us for Module 2, where we will dive into the three main financial reports: the income statement, the balance sheet, and the critical cash flow statement. See you in the next module.